Hello everyone, my name is Saurabh Patel and I am from Windsor, Ontario working with eXp Realty. On this channel, I discuss a lot of things about real estate, investing, and also financial freedom. And today's topic is very crucial for any real estate investor because before they even purchase the property, they should at least have rough numbers on how much rental cash flow is going to be from that property. So all of those things are going to be discussed in today's video, and without wasting time, let's just get started at it. So for calculating the rental cash flow, I have created a custom sheet on which you can enter the different values like monthly expenses, monthly income that you are getting from the property and other things. And you can get to know like what is the cap rate of that property, what is the return on investment on that particular property, and so forth. So let's just start with this sheet and I will explain the different terms and what are the details that you need to fill this information to get the desired value. So first thing is the purchase price. Right now, let's just start with whatever the list price of the property is. So for this instance, I am just taking it as a 500k is a purchase price. And this is going to be, if you're living in Windsor, it's going to be more kind of, you can get a legal duplex with that, or maybe a single family resident with a basement unit in-law suite on that. And that 500 price, if you rent out that whole property, the first thing you need to know like how much you can expect the monthly rent from this property. Now you can see the surrounding property with a similar size, similar structure, and you can get to know what's the monthly rent is going to be. And this kind of property in Windsor, you can have get around $4,000 a monthly rent from that property. So I'll just put a $4,000, and there are going to be other monthly income such as laundry, vending, parking. I've seen that many people who has duplexes or maybe have an extra parking, they rent it out those parking space to generate additional income. Even I have one of the property on which I am renting out the parking and I'm getting $100 per month from that. So you can use those extra income and put it over here. But right now for easier understanding purpose, I'll put zero because not all the property have those benefits. So that's going to be your gross monthly operating income. That's a $4,000 a month of rent. Now next thing is going to be calculate different monthly operating expenses. In monthly operating expense, mostly in investing property, I've seen that they give it to the property management firm if they have a large portfolio of property, and that is why I've included over here just to give you an idea. If you are giving it to property management, generally it normally lies around 8% of the rental that you're getting. So 8% of $4,000, that's 220 per month. That's management fees, which includes your loan maintenance and other maintenance on the property. Another thing is repair and maintenance that you have to pay out of your pocket, and generally this is going to be 1% of the purchase price, and you can get on a yearly basis. That's how much your repair is going to be. That's 416 in our case. Then there's going to be property taxes. So Windsor is going to be around somewhere 300 to $350. We'll take the higher end, and $350 for 500k property on a monthly basis. And rental property insurance somewhere going to be around $150 for this. We'll put it over here, 150. There's no condo fee, but if you're buying condo, you can add the condo fees for that. Now utilities, based on how you are going to set up tenancy agreement. Normally, most of the time, investor give out the utilities to the tenants. They pay their utilities along with the rent. So that's how much you can get the utilities. But if sometimes if the market is not strong in demand or your property is maybe somewhere off from the ideal rental location, then maybe to attract some good tenant, you can provide some utilities. And if you are doing that, you can add the option over here. Another thing is to consider is the rental equipment. Most of the time, the water heater or the furnace are going to be rental, and sometimes you have a water softener in your property. So all of those rental equipment, normally you are the one who is going to pay for that. So I'll just include $100 for that. Then cable, phone, internet again. This is more kind of tenant that pays it, but sometimes I've seen the investor, they put the cameras and security alarm system and they provide their own internet so they can manage it from their side. And if tenant moves, it doesn't get bothered on that. Like they have still the access for those security devices, cameras, and they can access it from anywhere. uh, so if you're doing that, you add those internet cost over here. Then there's going to be other miscellaneous costs, such as maybe if you're a good tenant, and then the landlord may provide you an extra benefits, maybe services, cleaning services, and stuff like that. And then you can over here, and there is going to be advertising cost. Now, if you're doing the advertisement maybe on the Facebook marketplace and you are running the paid advertisement, you can do it over here, or maybe you can also add the advertising cost. But for easier, we are not adding it. And another thing that many people forget is to calculate the vacancy rate and the credit losses. So normally it's not going to be in every time that your property is going to be rented. And sometime in a month or sometime in a year, it's always going to be empty because you have to find another tenant. So those tenants, when they are moving and new tenants are coming in, those period you are not going to get any like a monthly rent. So depends on your location, you can calculate, or you can contact your local realtor and get a vacancy rate from that. Windsor, you can get around 2% of vacancy rate, and it's mostly ideal for all of the locations. So that's going to be $80 per month vacancy losses or credit losses. So that's going to be your monthly operating expense of 1416.67. Now next thing is going to be NOIs, and it's basically sums of how much your annual operating income is, subtract to your annual operating expenses, and then you can come up with the NOI. So basically you can calculate, multiply 12 of whatever rent you're getting, in our case 4,000 by 12, and that's 48,000. And same thing with the expenses, you can multiply your monthly expenses and the operating expenses of 17,000. So those are going to be your net operating income of $31,000. Next thing to keep in mind is the loan information, because depending on your how much down payment you do, you have to come up with how much mortgage payment is going to be. So it's all easier, it's all done over here. And since this is an investment property, normally we'll do at least 20% of down payment. So for 500k, our down payment is going to be 100k, and that's what's going to be our down payment. You can see over here I added CMHC default insurance. Most of the time in investment property you will not get a default insurance, but sometimes I've seen the investor, they buy a property, they live it in the as a primary resident for 1 year, and then it gets converted into the rental unit. So in those cases your default insurance is always going to be there, and you need to add it over here to just calculate how much the cash flow is going to be. Loan amount is now basically how much your purchase price is going minus down payment. So that's a 400k your loan amount is. uh, we taken the 30-year mortgage with 5-year term, and we are taking 5% as conservative approach for now. I know the rates are a little bit decreased for now, but for easier sake we'll just take the maximum amount that you're getting, so 5%. Compounding period is semi-annually. Sometime depends on your mortgage, maybe compounding period will be different, so just keep an eye on that, and select what is your compounding period. Semi-annual is common, so our monthly mortgage is going to be $2,134.76 with annual interest of $19,660, and principal that you are paying on your mortgage on annual basis $5,956.90. So this is the loan information. It's automatically get calculated, so it's easier, you don't have to jumble around through different sites to find out how much your mortgage cost is. Now let's calculate the cap rate of this property, and it's automatically calculated based on the information they provided. So capitalization rate is basically, if you are investing, many people talk about how much the cap rate of the property is going to be, and 6 to 8% is ideal cap rate if you can achieve that. 4% is still good. So the cap rate is basically how much the purchase price that you're paying for and how much your net operating income is going to be. So you can divide net operating income by the purchase price and you can get the cap rate of that property. In our case it's a 6.20%, so it's in a good range. But sometimes when you are purchasing a property and you want to put an offer on that property, you have certain cap rate in mind. Like I do not want 6.20, and maybe some investor they say, okay, I want 7% of cap rate on that property, and then it will give you a spit out like how much you should put an offer of to get the 7% cap rate based on the monthly income and expenses on that property. So in our case, it's a property is going to be $442,857.14. So that's what your offer price if you want 7% of cap rate on that property. Now, one thing I've seen that many people are focusing more on cap rate, on how much cap rate is going to be for that property, and missing one important item. That cap rate calculation does not take consideration on the mortgage payment on the property, because you are paying the mortgage, so that is also another expense of the property. But right now, we did not consider the mortgage payment on that. We just use the net operating income, that's basically your income minus expenses without the mortgage, and divided by the purchase price of that property, and then we came out with the cap rate. So to calculate the cash on cash return or return on investment, we first need to know how much we invested on that property, and that comes up with the property acquisition cost. So for us, it's $100,000 on down payment, then land transfer tax of 6,475, and we are also assuming that this property is not in Toronto, because if it's not Toronto, then you have to pay the same amount of municipal tax. So basically, double the land transfer tax on that. There's no PST on the mortgage default insurance because there's no mortgage default insurance, so that's zero. Lowest fee we are considering $2,000. On higher end, title insurance $500, inspection of $500, and appraisal fee we are adding it because we are considering that bank is ordered us to pay the appraisal fee, and that's why $600. And we are considering there is no other expenses such as surveys, moving, tax adjustment, and that's why it's zero. So it comes up with our initial investment of $110,075. That's what we have to pay to acquire this property. Now we already calculated the monthly operating income, that's a $4,000, and monthly payment, so that's our expenses for $3,551.43. And if you subtract those, you can come up with the monthly cash flow amount, that how much cash you are making from that property. That's a $448.57. And if you multiply it by 12, you get the annual income of $5,382.88. And from that, you can now calculate the cash on cash return. And this is basically your total annual cash flow divided by your initial investment. And it comes up with a 4.89. And you can clearly see the difference between the cap rate of 620 and how much return on investment is going to be. Up until now, we discussed how much your rate of return is going to be on investment, and also how much your cap rate is going to be. But there is one other number that many investors focuses on, and I would highly discourage that one. Then people who are looking at that number are not actually doing them a service. And the reason being that they consider the passive appreciation of property while calculating return on investment. So basically what happened in this one, they calculate the total income that you are earning from that property. That's basically your cash flow from the property plus your principal recapture, because you're paying down your mortgage, so that's your equity that you build up with that property. And also the passive appreciation. They consider the 4% or 5%, depend on the neighborhood where you're living, of the property appreciation on year-on-year basis. That's basically on paper. You are not going to get into your hand until you sell your property. So that's 4% is get added on over here, and then you calculate your AR1 total return. That's basically all of those incomes divided by the initial investment. You come up with the number of 28.47. Now, why I do not recommend this? Because it is not considerate of the total cost that you require when you sell the property. It does not include the closing cost of the property. It does not include the realtor fees. It does not include other maintenance that you have to do before you sell your property. So all of those things quickly adds up, and your calculations goes away, and it comes with you will end up with a way lower number than this one. So I would not recommend to focus on this one when you are buying the property. The only number I focus on mostly is the cash on cash return, how much return you are getting based on your initial investment, and that's the one most important thing. Even I do not encourage to see this cap rate number because it does not include the mortgage cost on it. And there you have it. By now you understand how to do the rental cash flow analysis and why it is an integral part of the real estate investing. By doing the numbers, by knowing them, you can make a smart decision and ensure that you have long-term profitability. Thanks for watching, and I will see you in the next video. Happy investing.